The UK's in a recession, property prices, what's going to happen with them? Are they going to go down? Should I wait to buy property? Maybe wait 6 months or longer just to see what the market and how it's reacting. So let's have a conversation around this because property is very different from any other type of investment. Let's take stocks and shares. Stocks and shares, as well as cryptocurrency, are incredibly volatile in the sense that one day they could be going up, the next day they could be going down. All it takes when it comes to stocks and shares is good press or bad press on a company to see the stock value and the share price to either go up or to come down. And a lot of market manipulation happens with stocks and shares. And then you've got the cryptocurrency side of things, which is incredibly volatile. And there's constant narratives that come out which sway that crypto going up or going down. And that there, I'm not saying that you shouldn't consider or look to invest in those types of things there, but again, they're speculative. No one knows if they're going to continue to go up. No one knows if they're going to drop overnight. So with that in mind, you can't compare property to stocks and shares or crypto. Stocks and shares, if you think about it, with big tech companies or bigger organizations who have got certain share prices, if the economy starts to contract and go into a recession, as we go into a recession, what that means is that the economy is no longer producing at the levels that it was. And there's different definitions of what a recession is. Normally, it's defined as 2 negative quarters of growth. So if you've had 2 consecutive negative quarters of the GDP of a country and it goes under what it was previously, then you're declared to be in a recession. Now, when you go into recession, like what we've had many occasions, you notice that the economy is just contracting by a couple of percent. In the grand scheme of things, it's not a lot. But that then starts to shake up the marketplace. And then what happens if the economy starts to contract and we're in a recession? The narrative that's getting painted by the mainstream media is that we, as an economy, it's going to be a lot more tougher times. We need to be a bit more, careful with our spending. We need to save a little bit more. And then that there is what creates the trigger points for companies like big tech companies right now, like Facebook, who have come up with massive layoffs, Amazon, huge layoffs, and Google, you name it. Like there's so many companies just now, especially in the tech space, that are starting to lay off lots of people. Now, what happens when they start to lay off lots of people is that the stock price of that company is going to start coming down massively. Why? It's because, well, that looks like it's a company that's contracting and it could be issues, and that there has the speculation that everyone thinks, oh my God, the stock price is coming down, they're laying off lots of people, they must not be doing as well as they're doing. Once they go and post their quarterly revenue targets and income, it's not going to be as good, so people are going to want to start selling off the shares. So all that market manipulation as such is going on and taking place, and that's what makes the share price of Facebook or any other company come down. Right, through all of that that's happening. But the difference is with property in most locations, especially here in the UK, the economy doesn't really have a direct reflection to property. There's other fundamentals that we need to understand first. More importantly, supply and demand. We live in a small island in the grand scheme of things. There's massive demand for property. We have not built enough homes as per the demand. So from that point of view, there's not enough property for the demand for people to want to live in. So from this point of view, property prices will considerably still keep on going up. They might not be as explosive as it has been over the last couple of years because it's been explosive across the globe in all sectors, but there's still growth there. So for those that are waiting to see what's going to happen to the market, thinking there's going to be some sort of property crash, this is more of a consolidation period where property prices won't be as explosive, but because of supply and demand, they are going to continue to go up. Now, again, if you look at the Bank of England base rate, that is likely still going to keep on going up as well. At the moment, it's now over 3%. Is likely going to be forecasted to go as much as 4, possibly 4.5% before later in 2023 they see that then starting to come back down again, which again, this is just predictability. If you think about it, for almost a decade since 2008, 9, 10, interest rates have been incredibly low. Arguably, interest rates should have been at this level for many years now. So in a roundabout way, We would have been there if it wasn't for everything that happened with COVID, the lockdowns, the restrictions and everything else. That caused almost economic collapse, but we're able to get through that by printing more money. So with quantitative easing starts to print more money, that's never a good thing for our economy, because then that starts forcing inflation. And I read an article today to showing that salaries are expanding and growing across the workplace. But one thing that we need to keep in mind for is inflation in terms of the cost of products, the cost of goods, the cost of importing and exporting and everything else. So inflation has been high, but that's starting to come back down into reasonable levels to a point that it might be controlled again. Why? Because a lot of the issues that's caused inflation was because of the supply chain, mainly around all the lockdowns, all the restrictions. But now that's easing up again. More production levels are starting to go up again. Inflation's starting to come back down. So the funny thing is, even though it's clear that the UK is in a recession, even though it's not been officially declared, it's clear to see there's other countries throughout the world that are clearly in a recession because the economy is contracting. And that's going to affect stocks and shares, right? It's totally going to affect stocks and shares. It's going to have companies starting to restrict themselves and having layoffs and everything else. The difference from the tech companies, though, is that when they're laying off, thousands of people at any given time, is that that's skilled labor. And it's advantageous for other lower-end tech companies to go and acquire people from Facebook, from Twitter, from Google or Amazon, because it's skilled tech people that they can then go and acquire into their organization to help them grow. But the difference is, and what really starts to affect the economy, which then starts to affect property, is mass unemployment from unskilled labour. Now, unskilled labour is labour that can be easily, when I say easily replaced, it can be easily replaced from, AI, from machines. It's kind of unskilled, like anyone can do it. So take, for example, through a lot of the lockdown restrictions, many people who were trying to earn a living in their own business that they could not produce anymore had to turn to be resourceful and then became Amazon delivery drivers or delivery drivers to other companies because there was a massive demand for that and they had to do that, but they didn't have to have some sort of skill, they just had to be able to drive a car. And if by doing that, they got a role that could pay them during that period of time. So unskilled, you don't necessarily need qualifications or years of experience. It's when the unskilled labour market starts to get affected, then those unskilled people who will not easily get a job elsewhere because other companies are not hiring, then they become a financial burden on the economy, on the government to pay and cover their costs and support. And because they have to then support mass unemployment, they need to reduce their spending in the economy and spending on schools and spending on the NHS and spending on, the roads and everything that they're supposed to be trying to spend. And they cut back on all of that. And when they cut back on all of that, what happens is outside investment is like, well, there's no point investing in the UK. There's not going to be investment happening. So there's so much that needs to happen from an economical standpoint and a lot of trigger points before you start seeing property being affected in terms of house prices, especially when it comes to finance. Like right now, through everything that happened with the mini budget, it was chaos, it was crazy. Everyone thought that, the whole global economy was going to collapse, UK was going to collapse, it was just going to be a disaster. Bank of England base rate started to increase rapidly. Interest rates in terms of mortgage finance products were getting put up massively as well. But look at it right now. Early 2023, interest rates are starting to come back down to a reasonable rate, even though the Bank of England base rate is still increasing too. So the Bank of England base rate could still be increasing. However, mortgage companies are reducing their interest rates because they've got a longer term viewpoint. So if they can see in the market that interest rates will start to come back down again, then that's what keeps interest rates a lot lower. So I happen to own a mortgage company, expressmortgages.co.uk. If you've got an interest in finance or needing access to any, non-alternative high street banks, you want to get creative funders with good interest rates, you might want to check them out. But through Express, we literally write over £100 million worth of mortgages every single month. Like millions, tens of millions every single month. So I get to see it firsthand, how many people are looking for finance options, different funding options, you name it. There's mass amount of funders, especially development finance lenders, bridging finance lenders, who aggressively want to lend in the marketplace, who want to invest in property, who want to lend against property, want to lend against new builds and developments because they see a massive shortage. When you see Lloyd's TSB coming out saying that they're going to become one of the biggest landlords in the UK and they want to go and snap up lots of property, that's a clue that if Lloyd's are getting involved in it, if Warren Buffett's come out and saying we're now buying real estate in a big way in the States, there's some clues when mass institutions are coming in to then start snapping up and buying property, when the narrative is right now that landlords, get taxed hard, there's stamp duty costs, there's all of this here. Yeah, for the individual, it seems like it's very difficult and restrictive, yet big institutions are coming in and snapping up in a big way. Like, if that's not a clue that property prices have got so much growth to go through over the next few years, I don't know what is. So you should absolutely not be waiting to buy property. By waiting, what's going to happen is you're going to lose out in tens of thousands of pounds. You're going to miss out on opportunities that can be acquired right now. And the reality is, when you start to understand property, the game plan is to buy right in the first place. And I always say this, you don't have a property business if it's cycle dependent. If you're having to sit and wait for something to happen in the cycle of property, then you don't have the right strategy. You have the right strategies that you can apply when the market's in an explosive phase and property prices are going up. You need to have the right strategy when property prices are consolidating and properties being a little bit more sticky. And you also need to have the right strategy when property is starting to go down in value. So you don't have a property business if it's cycle dependent. You need to have the right strategy you can apply regardless to what's happening. But the best strategy is not to wait to buy property, it's to buy property and then wait. Buy it right in the first place. If you buy at discount, amazing. It's not always essential. Adding value is definitely essential. Making sure you're buying for cash flow in the right locations. Make sure you recycle your money. So you've got your acquisition cost to buy a property. It's made up of your deposit, the refurb, the legals, the stamp duty. So when you buy that property, you want to make sure you bought it at the right price, you're adding enough value, refinancing and pulling all that money back out, which means you've got nothing at risk. Yet you still have the equity in that property, you still have the cash flow in that property. If it goes down in value for whatever reason, your capital's not at risk. You've already got that out and away into another deal. So think about it. You operate right now, as you're watching this video, thinking about getting involved in property, you operate with the data and the knowledge that you have at this given time, this moment, to invest in property intelligently. Then in 6 months' time, you'll review the marketplace at that point and go, what's the right way to invest in property? What's the right strategy? But there's always a strategy regardless to the market conditions. And hey, if you've got questions, then make sure you pop them in the comments. And one of the most important things for me is to help many people start to understand the understanding about the economy, but more importantly, what happens with property and why it's different from anyone else. Because when you start to see this, you're going to see why this is a phenomenal investment vehicle. And what's crazy is like over 80% of those that watch this video are not yet subscribed to my YouTube channel. So do me a favor and subscribe, because the more subscribers I get, the more motivation it is for me to record more content, record more value, to get that out to you guys, to help you on your own journey through personal growth, through business, through investing, through making money, making financial and intelligent decisions when it comes to building your wealth. So make sure you're subscribed to the channel, hit that notification bell to be notified when we drop more content. And I look forward to sharing some more with you on your journey. But drop in the comments any questions you've got. Be happy to support and help.